Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines, and many other sectors.
Good afternoon, ladies and gentlemen. Welcome to our special show, Market Gurus. I am Shailendra Bhatnagar, joining you on Business Today Television. And on this show, we get you to meet some of the finest brains on Dalal Street who, over the last 2-3 decades, have been making money with their practically oriented approach towards creating wealth over the longer and the medium term. Our guest today is a special gentleman, Mr. Krishna Sanghavi. He is the Chief Investment Officer for Equities at Mahindra Manulife Investment Management. This is a mid-sized mutual fund where about 20,000 crore rupees are assets under management over 22 funds. Mr. Krishna Sanghavi has been in this world of investments over the last 3 decades, and he's worked variously with Canara, Robeco, with Aviva Life Insurance Company, as also Kotak Mahindra Asset Management. A warm welcome to you, Krishna ji, and let's start with the basics. How do you see sentiment on Dalal Street in this session over the last 1 month or so? What are the good points that you've been able to cull out, and what do you think are the pain points?
Thank you, Shail, for having me here. And see, honestly, sentiments are good. Let's not make mistakes. Markets have been kind to us on what happens normally in market. Really, markets is function of 2 things. One is the economy's ability to do well and show a growth map for what it can do better. And the second part is really the ability of investors, ability of market participants to recognize that growth opportunity, and maybe some people are early entrants, some people are late entrants, and obviously the early entrants always in a way get into this compounding category of investors where they make money over that cycle of economic growth, etc. So yeah, markets have been good. I think look at 1 month, 3 months, 6 months. Obviously, the output in a way can vary more shorter term you look at. But the reality is, yes, there is an economy which is growing in front of us. And the visibility for next maybe 3, 5, 7, 10 years is reasonably good, to say so. And to that extent, yes, with such a nice move in terms of economy, in terms of the relative opportunity also matters. So the financial markets, Shell, the way we really work is that people don't look at only the absolute growth, they also look at relative growth, and that's where India figures right now in a very sweet spot. Broadly, if you look at a slightly medium term, long term also, India has been consistently in that range of 3.5% over the world GDP growth rate on an average almost every year in last maybe 20-25 years. And so that's there. So more we look into past, obviously our past growth rate has been good. More we try to extrapolate for future. We have a reasonable comfort. Yes, our demography, our dynamics on reforms, and maybe the global opportunity offers that space. So to that extent, yeah, in a way, a lot of things are good on markets. The only challenge, if I have to really highlight on, especially you mentioned sentiments on Dalal Street, really is that you have 2 ways to invest in markets. One is a nice judicious way of saying, here is my saving, here is what I want to create wealth from, and I want to invest in markets for long term. Second set is, here is the money which I have. It's honestly, I want to make a quick buck out of it, which means I'm not really investing. I'm investing with a mindset of making money in a very short end. So in a way, I am possibly taking a different route to investing, which is called trading rather than investing. And I think that's the only sentiment which, back of the mind remains as a is the area which we all should be aware of. Saying that, is there too much of a trading mindset among many investors, or is it really the investment mindset?
Okay. Ladies and gentlemen, let's start with Krishna's performance over the last 1 year or so. As I had mentioned, Mr. Sanghavi manages 22 funds with a corpus of around 20,000 crores. But Mr. Sanghavi puts in a very decent punch. I'm looking at the small cap fund, the multi cap fund, the large cap fund, as also the focused direct fund. All these funds are in the upper quartile when it comes to the 1 year returns, and they've done fantastically well. The 1 year return on Mahindra Manulife small cap fund, ladies and gentlemen, is 66%. On the mid cap fund, it's 57%. And in the quartile where Mr. Sanghavi lies is the upper one, the first upper 2-3% quartile in terms of returns. Krishna ji, let's now sort of discuss your interpretation as to how third quarter earnings came out. Today was perhaps the last day where corporate India was able to come out with unaudited performances. What have been the hits and misses according to you, and where do you see over the next 2 or 3 months that the market will move based on these earnings?
Yeah, sure. Yeah, I mean, last 1 year and maybe slightly longer period of 2 and 3 years also has been seen quite a few of our funds where we have that 2-3 year track record in place. So I think if you look at how the quarter 3 results season, I think the broad analysis is that the result season has been quite decent. Unfortunately, in this world of reasonably good amount of research and tracking and expectations driven world, I think quite a few bit of this thing I can say has been more or less in line with the expectations. Those expectations of earning broadly has been delivered across space, whether it's automobiles, whether it's financial, whether it's capital goods, and partly even IT also, because actual earning may or may not have been as great for any of these sectors, but to the extent we live in a reasonable world where there is an expectations driven by research coverage, as long as you meeting those expectations, so on an average I'll possibly say results have been neutral to positive in terms of outcome. You'll always find couple of either companies or sectors maybe missing the mark, but that's part of it, because one nice thing which we all should remember really is that one sector's expense is other sector's income. So sometimes the interlinkage of economy plays out so nicely that there is one sector which consumes a particular resource and other sector produces the same resource. So to an extent, some sector or some company makes a lot of money. One can imagine it can come at cost of some other sector, some other company, but that's what all this things works out. We are a nice, as I said, capital goods has been good, financials have been decent. I think the only area of challenge perhaps has been little bit on the consumption, especially more on the staple side. That's some area where as of now things haven't been as great as what we would like to see. At the same time, the way the outlook for next 12 months, especially with elections being around the corner, and during election time, lot of spend happens, lot of things happen, for the lower income category of consumers, and to an extent gives them purchasing power. So even we do expect that also to let's say play out. Honestly, from a market mood perspective, very difficult to predict or anticipate what lies ahead in next 3 months, especially where we live in a world where there is every 45 day a US Fed meeting which decides their own outlook on interest rate, and globally, unfortunately, the sentiments have moved slightly more towards interest rate driven volatility on the asset class called equity. So to an extent it's difficult. At the same time, with if you look at post election, which is again while we speak today, maybe more or less we are exactly 3 months ahead of when the results for elections would be out, which is somewhere in third or fourth week of May results will be out. So I think if you leave aside that and focus slightly beyond that, yeah, there is a reasonable clarity, visibility of our government in place, their own priorities, their own policy reform actions, and we do expect corporate capex to revive in a reasonably meaningful way. Uh, we also expect the focus for the government to be more on the core economic sectors called power, oil and gas, metals, because these are the things where structurally we are in a situation where over next 3 to 4 years, almost each and every variable in this core economy sector might reach a stage where demand supply gap might move in favor of high demand and lesser supply. And as we know, these are the sectors which take slightly longer time period from gestation. One belief is that we'll move into capex mode on those core economy driven businesses far more.
Okay, so Sanghavi, let me just address the elephant in the room, which is this a very sharp re-rating and an equally ferocious rally that we've seen in the PSU basket over the last 2 months. Of course, if you ignore the last 4 or 5 trading sessions where an equally damning correction has taken place, how are you looking at your picks in the PSU sector? I analyzed a lot of your funds. You seem to be focused on the large cap ones, NTPC, Coal India, State Bank of India. You're looking at large cap established names rather than the ones that seem to be moving fairly rapidly. What is your thought on the PSU basket?
Shall I think let's go back to the previous discussion about core economy related sectors. And then you find a lot of these PSU companies are very much, present in core economy sector, whether it's power generation, whether it is coal mining, whether it is, manufacturing, maybe oil and gas, whether it's oil refineries, whether it's oil production, or whether it's corporate lending, because let's not forget that for a lot of this corporate capex to play out in the core economy sector, you need a corporate lender to be available. So when I look at, that basket, yeah, you do definitely have a situation where PSU companies have far more dominant presence in those business verticals called power, called oil and gas, called corporate lending. So to an extent, your positioning in some of these companies is driven by the sectoral choices rather than they being PSU. But yeah, you're right. We do have a reasonable, position in many of our funds on some public sector units because they are very much present in the economic sectors which we are bullish on, and far more large cap than maybe mid and small is a very right analysis you've done. Yes.
Okay, Krishna ji, let me just drill this point a little further. In the last 2 months, when you look at this PSU basket, and this is center stage, right from the parliament to the smallest retail investor is enthused about this very sharp run-up that has happened. Tell us very broadly, have you added any new PSUs to your existing assets, or have you just added to your existing PSUs?
No, we would have obviously done what is required from a portfolio, management perspective, and to an extent, yes, we might have added, some new stocks or possibly added weight to an existing stock because, see about how this positioning PSUs, is that we coming in some of these PSU companies from a 5 and 10 year cycles of underperformance. They were the same set of companies which were present in economy, present in markets. Economy was giving them earnings, but unfortunately market was giving them a lower valuation multiple for the same earnings. We are moving to a situation where maybe some of these companies being in core economic sector, were possibly impacted by, the narrative of ESG. And as we all know how powerful that ESG narrative was in last decade, where a lot of companies in this core economy sector were not getting investor participation because of ESG narrative being against them. While we speak, what's changed? Yeah, what's clearly changed is, post this Russia-Ukraine war, lot of behavior in the financial market, especially the global investors' mindset about ESG has changed. What has also changed is partly the economic growth momentum, has created the earning capacity or the earning potential for some of these PSU companies or those sectors have realized, and again, some of these companies being in the core economy sector, let's remember, they have to invest at a time for a slightly higher capacity. Initial period, they may suffer from a slightly lower utilization levels, and as economy picks up, they reach their peak of maybe 95, 100% kind of utilization, and that's the time they get to the next cycle of capex. So what's been happening in this PSU, if I look at a 10-year cycle, has been that they were present, but may were partly underappreciated from market side because of ESG variables. Partly, they were having their own levels of capacity utilization, which was slightly lower. While we speak now today, I think a lot of things have changed for them. Yes, I understand. Valuations also have changed, and that's a tough call, honestly, in a live fund management environment where one has to worry about absolute valuations also over and above what has changed, and that's what we keep on trying to do in the portfolios.
Krishna ji, I'm checking out your largest fund, which is the small cap fund, an asset base of about 3,500. This one's done excellently well, returned about 66% over the last 1 year, handsomely beating the index, which has done fantastically well too. When you look at this whole universe, are you able to put a common set of valuation parameters while picking new stocks? How difficult is it to these days to sort of look in the rear view mirror, look at a 66% return in 1 year, and then look at expectations ahead of you, and then maybe decide on stock picking? How difficult is it these days?
Honestly, the easiest way to look at really is that, there is a particular return for the fund, but there was a particular return for benchmark also. So I better to start, with that mindset. Okay, the actual return is a function of what the underlying called small cap as a segment as a market has done, and what maybe the extra positive or the negative as a case may be for any of the funds, because that at least brings that hurdle rate slightly down to manageable levels. Because you're right, 66 is something which is almost impossible to assume for anyone to be able to let's say compound. I think better to look at relative to the benchmark move. So to that extent, that's right. I think post the last 12-month run up in broad markets, especially small cap segment, one really has to take a pause to reflect whether it makes sense to really continue to believe in small cap companies to deliver at from the current valuation points. It's slightly tough, and that's where the old adage comes in. That markets move in rotation. There are large caps, there are mid caps, there are small caps, and each of them variables have their own nice interconnectivity. As some large cap company will typically be a consumer or a supplier to a mid and small cap companies. Their own understanding of volume value equation or the price profit pool varies between times, and to that extent, yes, I'll believe that maybe we reach some of this good set of returns, and that's the time they may just need to consolidate for some time, that sometime maybe 6 months, maybe 9 months, for the time earnings to catch up going ahead, and then you come back. Because let's not forget, exactly a year back had we met, we all verified we're sitting on a base of maybe 50-60% returns on index. We all know how maybe attractively those segments were looking at in the market. It's just that maybe that inflection point perhaps was not visible 1 year back, and not many would have anticipated index itself giving a 50% plus kind of returns. So that's the challenge of markets. There's a challenge of trying to judge incremental market behavior. But from economy side, yes, we do believe that linkage exists, where the kind of growth path India has, there are n number of companies in the Indian market space which have potential to deliver the growth. In fact, look at the universe today, right? We have nearly 510 companies which are, $1 billion plus market cap. It's a very large universe, right? You're talking about 100 large caps, 150 mid caps, and the remaining 360 odd small cap companies available for $1 billion plus market cap. So to that extent, yeah, investable universe is large enough, and that offers reasonable opportunity for from a portfolio pick and portfolio management perspective.
I agree. In a country like India, where you get about 10, 12, let's just say about 5-8 companies on a monthly basis, 5-8 decent companies on a monthly basis are also getting listed. So
Yes.
This catchment is always improving for the better. Krishna ji, let's also look at how Mahindra Manulife is trying to expand its portfolio of offerings, and you are in the market for a multi-asset allocation fund which opens on February 20th and will shut shop on March 5th. What is the logic at this point of time when the equity markets are roaring that you come up with a multi-asset thought? One, how will this fund work? What will be the capital? What will be the asset allocation? And of course, the reason behind this launch.
Sure. So, as the name multi-asset allocation goes, essentially, what we really offering is customers a product choice where there'll be equity as an asset class. That asset class is, let's say, benchmarked to NSE 500, which means a reasonably flexible mandate on large cap, mid cap, small cap within the equity portion. The equity portion, the range is 35% minimum and 80% maximum. So again, a reasonable canvas from a portfolio allocation standpoint to equity. Equities can actually go in a way, from a mandate perspective, as high as 80%. And anyway, broad intent to remain minimum 35 kind of thing as a intent on portfolio side. I think the other two asset classes really remaining being fixed income, and the commodities may be essentially led by gold as a primary asset class within commodities. I think the broad idea is that every investor has to go through asset allocation route. In fact, asset allocation is one of the core tenets of investing. So there are a lot of investors who possibly may be doing it already on their own, saying that how much money they want to put into equity, fixed income, and maybe gold. For a lot of investors, maybe gold might be the only asset class out of the other commodities. But the idea is, they may or may not have either the right skill set to decide what changes to make. At times, some of those changes may or may not have their own tax efficiency because of asset class movements. Here is a fund where as a fund house, what we're really offering is that we have a product called multi-asset, which is having its own equity, fixed income, and the third asset class, which is in a way, let's say, commodities as a broad word, with gold being, let's say, a dominant asset class there. We are offering, a product where we as a fund managers would look to choose, right asset allocation between those three asset classes based on our understanding of how relative attractiveness of each of these asset classes are at a point of time. And whenever, we feel there is a need for a change, if you're able to spot a catalyst for change which says, okay, we can move from one particular asset class to another in a different weight allocation, all within that offer document mandate which we specified. We would like to do it saying that, okay, there are good times for equities, maybe there are weaker times for equities in terms of valuations, and for some point of time you move asset class. We in a way it's a natural extension of what we already offer. We as a fund house, we offer equities, we offer fixed income in different funds. So what we're really clubbing is our capability to merge both and spend some time on deciding asset allocation between the two class at our level as a fund manager, and clearly add the gold and other commodity based investment opportunities which have their own meaningful say, I think, in every investment portfolio.
Okay. Krishnaji, when you look at the broader markets, you mentioned about 551 companies having a market capitalization of more than $1 billion, and a smart appreciation of the last 1 year has come into these prices. Are there some sectors, some pockets of overvaluation, of froth, of excessive price points that you observe in this market?
Yeah, I think market always has, some areas of, that's the nature of the market, right? Money moves possibly between areas of exuberance to areas of, deep value. So there always will be spots, honestly. But, the beauty of markets really is, those pockets get filled very fast. So if I just get little bit into past, maybe, yeah, 1 year back, perhaps, with this little bit hindsight of what we've done on the markets have done rather on small cap, mid cap front, maybe the real pocket of valuation gap was small and mid cap. Now that's been broadly captured. Today, we believe that one pocket which remains good is possibly large cap, where there is a nice need to catch up on the large cap valuation front, having seen the valuation captured from mid and small in last 1 year. If you look at sectorally also, yes, there are spots where one do expect reasonable, re-rating opportunities still available. I'm obviously not really, speaking too much on the earning growth rate, because our earning growth rate led, growth is already part of a lot of these calculations on expected earnings for next 12 months or so. So the other part of the sector really, is how one goes ahead into this, maybe benefits. So I think one area nicely is capex cycle led companies, which are looking good on both the front, the development of those capex cycle companies as well as, the suppliers to that. Maybe corporate lenders is another variable, and yeah, somewhere I think consumption led, growth could come in next 12 months, can be the third angle, yes. Because as mentioned, there is this election and, the economy, and that can create that required, momentum for consumption to pick up.
Okay. Krishnaji, when you look at the macro picture of India, the government just passed the interim budget for till the month of May for its expenses. Any 2 or 3 broad points that you think are fueling this medium to longer term rally in the market, which were a result of this interim budget?
Yes, sure. I think that the core story for India, honestly, is, the positive demography which we enjoy as a country, the kind of, policy reforms which we are doing, and maybe third is, the digital world which has created a lot of opportunity for eliminating efficiencies, making them more organized, and, resulting in better, not only earning for government, but also, for the economy as a whole. I think those core principles remain. If you just decide to step back slightly, maybe 15 years back, we were actually 14th rank economy in the world. That 14th rank has become 5th now, from 2006-7. If I start maybe as a starting point, and today we are at a nice jump in economic ranking. That is nothing but reflection of how our economy has grown. From this 5th, we are likely to be number 3 in 4-5 years. That 4 might become 3, 5 might become 6. But I think the direction is honestly more important. That's our upside. That remains. A lot of issues, which is policy reforms, etc., is in place. So those things are honestly there. Financial ledger of saving is the next relevant area from economy, and by default equity market angle that also is positive.
Yes. Okay. Krishnaji, Mr. Modi has categorically said that his third term, Modi 3.0, would be peppered with policy reforms aimed at improving our economic standard. What are the 2 or 3 broad ones that you expect him to carry out?
Yeah, I think the roadmap to infrastructure creation is something very critical, because in this journey of growth, we will reach a lot of infrastructure related activities which should not actually act as the bottleneck. So unless policy reforms on that front is in place, I think we'll get possibly that part is one. Second is incentive maybe for economy. for corporates to carry out those businesses. I think those are the things. Otherwise, yeah, we are honestly a lot of efficiency driven, a lot of policy reform driven in actions have happened, which are more or less there. And now we're discussing more of incremental reforms to direct particular growth area for a particular segment of market, and which honestly policymakers will know far more. Hopefully, while we speak, that Amrit Kal vision document is still something very much likely in next maybe couple of months or so, and that will also give us lights on what where all government intends to spend, and that it creates a nice opportunity for all of us to understand that.
Okay. Mr. Sanghavi, thank you so much for your time and the brilliant thesis that you hold as far as this bull run is concerned. Our best wishes and congratulations to you on this new NFO that's coming up from Mahindra Manulife, and may the fantastic performance of all your funds continue that it has over the last 1 year. Thank you so much for your time, sir.
Thank you, Shail. Thanks.
Okay. That, ladies and gentlemen, was Mr. Krishna Sanghavi. He's the Chief Investment Officer at Mahindra Manulife Investment Advisors. He runs a very tight ship, 20,000 crores in terms of asset under management, and a fantastic performance over the last 1 year for many of his large mid-cap, small-cap funds, as also the flexi-cap fund. Thank you for watching us on this special episode of Market Guru. Remain glued to Business Today for all your financial news needs. Thank you from my side and from my PCR team. Have a nice evening.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe for multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines, and many other sectors.
Celebrate 32 years of leadership in business news with Business Today. From the groundbreaking AI cover of Sundar Pichai to PM Modi's exclusive on G20, we redefine headlines. Now our 32nd anniversary issue explores India 2029, the 5-year agenda, with industry titans sharing exclusive insights. So, just BT it for unparalleled perspectives. Business Today. 32 years of leadership, innovation, and business brilliance. Subscribe now. In today's rapidly evolving business environment, when risk is omnipresent, managing risks is no longer just about ticking a few boxes. Businesses need to maintain a panoramic view of risks to stay ahead of the curve. Join us to explore how organizations can rethink risk to unlock new possibilities and become fit for future. At PwC presents De-Risking the Future in collaboration with Business Today.